Hello everyone, welcome again to one more class on future contract. So last class I have discussed about the concept of initial margin. I have discussed about the concept of maintenance margin. I have talked about something called margin call. So I have explained all these terminologies. I believe you have understood that. In case of your doubt, what I thought of to take one more class where through MS Excel I'll try to explain this concept. So now we're going to talk about the concept of M2m settlement. M2m stands for mark to market settlement. So in the case of future contract, the exchange want to make sure that the default risk does not happen. An exchange follow the concept of novation, where for the buyer they act like a short position holder, while for the seller they act like a long position holder, where buyer need to worry who is the short position holder and seller need to worry who is the long position holder. So I thought to explain this with an example of what I am explaining from last so many classes, where assuming that the underlying asset is the potato, where the long and short they came together that they will do the transaction at 11 rupees per kg, and assuming that the spot price of the potato is 10 rupees per kg. Spot price means the price at which the potato is trading in the mandi market. So suppose the spot price is 10 rupees per kg and they decided that they will do transaction at 11 rupees per kg, and the total quantity which was agreed was 10 kg. So the total value of the contract will become 110 rupees. And suppose the potato is not such a volatile commodity, so the initial margin as fixed by the exchange is 30%. So 30% of 110 would be 33 rupees. So once the contract will start, both the long and short position holder, they will deposit 33 rupees with the exchange, and that money is called as initial margin. Okay, now what the exchange will do, every day exchange will do the settlement of the contract. Settlement of the contract, that is called as mark to market settlement. Okay, so in mark to market settlement, what exchange will do till the next 3 months, because the total time of maturity of the contract is 3 months. So every day for the next 3 months, exchange will assume today is the day of settlement and yesterday was the day if the contract would have started. Okay, so on the first day, suppose after first day, the price of the potato in the mandi market become 12 rupees, and the day before and the day on which we agreed the transaction, that was yesterday, that day the price of potato was 10 rupees. So imagine yesterday you have agreed and that day yesterday was 10 rupees, and today if the settlement is going to happen and the price become 12 rupees, it means it's a 2 rupees gain to the long position holder per kg, and 2 rupees gain loss and 2 rupees loss to the short position holder per kg. So what exchange will do, exchange will not keep your money idle in your initial margin account. Exchange will debit or credit 2 rupees per kg from the account which is on loss side, and put 2 rupees per kg on the account which is in profit side. So here, since the price is increased, so the long position holder is on profit side and short position holder is on loss side. Okay, so 2 rupees per kg into total contract which was 10 kg, so that means 20 rupees. So what exchange will do, 20 rupees exchange will remove from the short position holder account, and the short position holder account become 13 rupees, and 20 rupees they put into long position holder account, and the long position holder account become 53 rupees. Okay, now next day will do exchange will do mark to market settlement. Now the next day the price of the potato suppose become 9 rupees per kg. It means it is a loss of 3 rupees per kg for the long position holder account and profit of 3 rupees per kg for short position holder account. So 3 into 10, so that is 30 rupees. So 30 rupees they will remove from the long position holder account, and his account become 23 rupees, and 30 rupees they put into short position holder account, and its account become 33 rupees. I hope you're understanding this concept. So what will happen, so if 30 rupees if they remove from this, and 30 rupees if they put from in his account, now his account become 43, his account become 23 rupees. Okay, now again the next day exchange will look into the price of the underlying commodity. Now it become 12 rupees, so it increased by 3 rupees per kg. 3 into 10, why 3 into 10? Because the total quantity what they agreed was 10 kg. So that means 30 rupees, again 30 rupees they'll remove from short position holder account and put 30 rupees into long position holder account. So this is called mark to market settlement, and this exchange will follow every day till someday if any of the person account touches maintenance margin. Maintenance margin is the threshold margin what they need to maintain with the exchange. Imagine in any scenario if your account touches the maintenance margin, or it become less than maintenance margin, then you get something called margin call. Then you get something called margin call. So margin call is the situation what one person will receive if the account of that person, if the account of that person touches the maintenance margin. Because what do you mean by touching the maintenance margin? So if your account touches a maintenance margin, it's like a checkmate. Okay, so your account touches maintenance margin means now it's reached the threshold. It's like what you expected is not happening. And if thing is not if thing is not happening what you expected, it means there's high possibility that you will default. So before you default, exchange will give you chance that do you want to continue. Suppose if any case, if one of the person account become 10 rupees, so it means if it become 10 rupees means what? It means the other person get a chance that because maybe why the initial margin of short position holder from 33 rupees become 10 rupees, because maybe the continuously the price of the underlying asset is increasing, and because the price of underlying asset is increasing, so because of that reason there's high chance that thing is not happening what short position is thought. So what exchange will do, exchange will give you chance that do you want to continue. If you want to continue, then next day your account should be refilled with initial margin, means now you have to deposit 23 rupees to the exchange and your account should become 33 rupees. Then only the next day the trading will happen. In case if the short position holder does not deposit 33 rupees, then that movement only the trade will cease off. If the trade will cease off, what will happen? Then the long position holder will receive 53 rupees, means his account from 33 rupees become 56 rupees, so he get a gain of 23 rupees, while the short position holder account from 33 become 10 rupees, means he got a loss of 23 rupees, and that movement only the trade got seized off, and the long position holder got 23 rupees and short position holder got a loss of 23 rupees, and that way no default happened. In case if you want to continue, then the short position holder has to deposit additional 23 rupees, and once he deposits the additional 23 rupees, now it account become 33 rupees, and now the next day the trading will happen, and next day again the mark to market settlement happens. So I hope you understood the concept of initial margin and maintenance margin. And through initial margin and maintenance margin, what exchange basically do, exchange create the possibility that no default happens on the exchange. This is the concept of future contract. So future contract is basically, it is a standardized agreement where both parties come together, and at the beginning of the contract only the both party has to deposit and money with the exchange, and that money is called initial margin. And exchange every day follow M2m settlement to make sure that the possibility of default does not happen. Okay, so this is the way how the future contract works. So either you talk about future contract or either you talk about forward contract. In both the case, in both future and forward contract, both long and short position holder they have the obligation to follow the contract in the future. So if you talk about future contract or if you talk about forward contract, in both case, both the long position holder and short position holder, they have the obligation to follow the contract in the future. So if you look into the payoff diagram of both long and short position holder, for them the payoff diagram is always a linear payoff diagram. So this is the payoff diagram what I have drawn for long position holder, because if the price of the underlying asset become more than 11 rupees, then the long position holder will get a gain, and his gain would be the difference between the price minus 11 rupees, because 11 rupees is the exercise price what they have agreed into the contract when they entered into the contract. Okay, while in the case of short position holder, the payoff diagram of a short position holder would be like this, because short position holder has agreed to sell the underlying asset, because short position holders agreed to sell the underlying asset 11 rupees per kg. So if the price will increase, then the short position holder will get a loss, and if the price will be more than 11 rupees, then the short position holder will get a gain. So this is the way how we decide the payoff diagram. Above this line is your profit and below this line is your loss. So this is the payoff diagram of a short position holder, and if the price is less than 11 rupees, short position holder will get a gain, and if the price become more than 11 rupees, the short position holder will get a loss. So this is the way how you can understand the payoff diagram. So either you talk about long position holder